Hello again, this is Terry Price, and welcome to the next chapter in our series entitled Tax Cuts and Jobs Act of 2017, How This Affects You. I hope you enjoy. Welcome to Chapter 1 of the video series entitled Tax Cuts and Jobs Act of 2017, How This Affects You. This chapter will cover the changes to standard deductions and personal exemptions. First, let's define what a standard deduction is. The IRS defines a standard deduction as a dollar amount that reduces the amount of income on which you are taxed and varies according to your filing status. There are also an additional standard deduction for individuals who are blind or age 65 and older. As with most IRS definitions, just because you read it doesn't mean you understand it. So, in plain English, a standard deduction is a tax deduction gimme. You can claim this amount to reduce your taxable income without having to maintain or add up all your receipts. You can either itemize your deductions, which is your medical, state and local taxes, mortgage interest, contributions, and other deductions, on Schedule A, or claim the standard deduction, whichever is higher. Naturally, if you do itemize deductions, you do have to maintain the proper documentation to support them. This definition of the standard deduction has not changed from previous tax years. So, what has changed about the standard deduction? First, let's look at what the standard deduction amounts that were used for your 2017 tax returns. If you filed single or married filing separately, your standard deduction was $6,350. For married filing jointly or qualified widower, sometimes called surviving spouse, the deduction was $12,700. For head of household, the deduction was $9,350. You then add an additional amount per person, $1,550 for single and head of household and $1,250 for married individuals, for everyone listed on the return that was legally blind or 65 and over to determine your total standard deduction. Here are the standard deduction amounts for 2018. They have all nearly doubled. If you filed single or married filing separately, your standard deduction is now $12,000. For married filing jointly or qualified widower, the deduction is $24,000. And for head of household, the deduction is $18,000. The amount that you add per person for blind or 65 and over is $1,600 for single and head of household and $1,300 for married individuals. This is a significant increase and will change many tax returns to claim the standard deduction instead of filing itemized deductions. Let's review and see how this will affect you claiming itemized deductions. If you itemized in 2017, review the Schedule A form and look at the total at the bottom of the form. If the total is higher than your new standard deduction is going to be, then you will most likely still itemize for 2018. You will need to gather all your information concerning medical, taxes, interest, contributions, and other deductions as you have in the past. If the number is close to your new standard deduction, you will need to gather all your information and calculate to see if you exceed it or not. There is no real quick way to determine without all the necessary information. If the number is lower than your new standard tax deduction, you will most likely be claiming the standard deduction and will not need to complete the Schedule A itemized deductions. This can significantly reduce your time in collecting information for preparing your taxes. So far, this is sounding pretty good. Getting an additional amount to deduct is always a good thing, right? So, what's the catch? Let's talk about personal exemptions. Personal exemptions is an additional deduction amount based on the number of individuals claimed on the tax return. The amount per person for 2017 was $4,050. For example, if you filed a joint tax return with two qualifying dependents, you had 4 exemptions that you could claim. This calculated out to be an additional $16,200 reduction in your taxable income. For 2018, this exemption is gone. It has been suspended, thus eliminating this additional reduction in taxable income. The government giveth, and the government taketh away. So, how do we stand? Has this change hurt us or helped us? I need you to pull out your 2017 tax return so we can compare some numbers. If you filed a 1040EZ form, review line 5. The amount should be less than the new standard deduction. The EZ form does not allow for itemized deductions nor dependents. Therefore, the benefit is always going to be positive. If you filed a 1040A form, you need to add lines 24 and 26 together. If the amount is less than your new standard deduction amount, then you benefit from the new laws and will have a greater reduction in your taxable income. If the amount is greater than your new standard deduction amount, then you will have less deductions against your income, resulting in a higher taxable income. If you filed a 1040 form and used the standard deduction in 2017, or if you itemized in 2017 but will most likely use the new standard deduction because your itemized deductions are less than the new standard, then add lines 40 and 42 together. If the amount is less than the new standard deduction amount, then you benefit from the new laws and will have a greater reduction in taxable income. If the amount is greater than your new standard deduction amount, then you will have less deductions against your income, resulting in a higher taxable income. If you filed a 1040 and itemized your deductions, and it appears you will continue to itemize even with the higher standard deduction, then the loss of the personal exemptions will result in a reduction in the total deductions against your income, resulting in a higher taxable income. Now keep in mind, this is just providing an overview of where you may stand based on 2017 information. Naturally, 2018 income and expenses may be significantly different, thus creating a different outcome. Other things to consider. If you are filing separately, then both spouses must file in the same manner as it pertains to the standard deduction. If one spouse files a Schedule A for itemized deductions, then the other spouse must as well. The second spouse cannot claim the standard deduction, no matter what the bottom line of the itemized deductions are. The only way you can claim the standard deduction on a return being filed as married filing separately is that both spouses claim the standard deduction. If you are claimed as a dependent on someone else's tax return, you do not use the standard deduction amounts as previously shown. Your standard deduction is the greater of $1,050 or $350 plus your earned income up to the appropriate standard deduction amount. The new law has repealed the 3% phase out for itemized deductions for high income. The previous law required you to reduce your itemized deduction by 3% of the amount of your adjusted gross income, or AGI, above $261,500 for single, $313,800 for joint, $286,650 for head of household, or $156,900 for married filing separately. Therefore, if your AGI, line 37, was above these amounts, take your AGI and subtract the threshold amount mentioned above. Multiply that difference by 3%. If that is greater than your personal exemptions on line 42, then you get a green thumbs up concerning this section of the new law. I don't want you to get too concerned at this point if you ended up with a red thumbs down. There are several other changes that we will be covering later in the series that may turn things to a green thumbs up. So, stay tuned. Thank you for watching this chapter of our series covering the changes to the standard deduction and personal exemptions. We greatly appreciate your time. Join us next time as we'll be covering the medical expenses, and changes to the Affordable Care Act. Thank you. For more of this video series covering the Tax Cuts and Jobs Act of 2017, be sure to follow us on Facebook. You can find us using @TerryLPrice CPA. For previous chapters of the series, go to www.terrylprice.com/CPA and click on videos. There you will find all the previous videos. If you have questions, please email us at cpa@terrylprice.com. Please do not post tax questions as a Facebook comment. This video series is to provide some basic information concerning the recent changes in the tax laws. This is not to be considered tax advice. Please consult your tax preparer to analyze your individual tax situation. Thanks for watching.